Hello and greetings from Utah. I'm out walking the dog and it's a beautiful snowy day here in Utah, just the way I like it. The weather reminded me a little bit about the economy, so I wanted to make some comments about that. If you are looking at the market today or even over the last few weeks, you see the excitement that the stock market is having with the price recovery as we get into kind of a Santa Claus rally, and the excitement, the enthusiasm is all about fading inflation. Now, if you've followed me this past year, even over the last 2 years, you'll know that I have not been concerned with inflation at all, because a lot of it is just an overhang of the excesses that we saw through the pandemic. The Federal Reserve created a lot of that. They can take it away by raising interest rates as they're doing. And it's also a matter of supply chains and different supply chain disruptions that are working themselves out. A year ago, 18 months ago, when people were freaking out over the price of lumber, I said, listen, it's not an existential threat. You know that because the price of timber is barely going up at all. So it wasn't like the world was running out of wood. It was simply bottlenecks in the system. And now those lumber prices are pretty much back to where they were pre-pandemic. I think a lot of assets are going back to that level as well. In any case, as far as inflation and all the excitement about declining inflation, again, this is nothing new. If you follow the leading economic indicators, you know back in as of March of 2022, copper peaked. And back then I was saying that that's a clear indication that recession is fading. So all the excitement now that's driving the market up, I think is as unfounded as all the pessimism was when the market was going down because of concerns of inflation. Now, that doesn't mean that I'm not concerned about the market, because right now I am. I'm worried because of declining overall economic conditions, and specifically in terms of corporate profits. Corporate profits are, the estimates for next year are still way too high, although they're coming down abruptly. Last week, JP Morgan reduced their expectations down to 205, and I think just the other day I saw RBC had taken it the lowest I've seen it so far. They're at 199. Now, I just recently did a full audio podcast episode where I talked about valuations and how profits factor into that, so I won't go into that now. But the key point here is that, just 6-8 months ago, people were talking about 2023 profits coming in at above 230, some estimates in excess of 250. Now we're down to about 200. That's a big difference. And when you factor that in to where the price in the S&P 500 is, especially today with the big bounce we had with the CPI enthusiasm, you're looking at about a 20 or 20 and a half times valuation. That's way too high given where interest rates are and how it would be estimated that next year is going to be pretty tough in terms of overall corporate profits, because ultimately the price of stocks is derived from corporate profitability. So bottom line in all this and how it relates to the weather, as I walk around out here and I see all the clouds and the snow, I'm not sure how well you can see it in the video here, but it's a pretty cold and snowy day here in Utah. But you know what? We're not even in the heart of winter yet. This is just a prelude of what's coming. And that's where I think we're going to go with the stock market. I think it's going to go lower because corporate profits are moving lower, and things will get worse until we get into the spring. And just like this weather will clear up sometime in April or May, I think between now and then, in terms of the economy, we'll see a downturn in the S&P 500, likely to get as lower than we saw this past October in that downturn. Now, I'm not predicting gloom and doom here. I think this is a fantastic buying opportunity because, again, just like it's cold and snowy right now, 6 months from now, the weather will be pretty nice. And I think that although there's still a lot of bumps along the road in the economy and the way things need to work out from a geopolitical situation and in overall global trade, it's going to be a much slower year next year than most people are anticipating. But that is a buying opportunity because what it forces companies and corporations to do is to become more productive. I like to say that markets adjust and people adapt, and that's because the things that are driving the corporate profits down right now will be adjusted in the future, and that'll make profitability go up and be even higher. And those are things like labor costs. So right now we see very high labor costs. Companies will be laying people off, and in the long term they'll be buying capital equipment to make themselves more productive. And so what you want to look at is companies that are improving their productivity, and you want to invest in those companies as well as investing in the companies that are providing those products and services that allow companies to become more productive. But I digress. Hey, in any case, happy end of year celebration for whatever you may celebrate. Happy Hanukkah, Merry Christmas to all of you. Thanks for tuning in, and we'll probably see you again in the new year. Until then, as always, this is John Pugliano wishing you the very best returns.